2021 meeting of the Financial Audit Advisory Committee to order. And I'm going to call roll for the members of the committee. Wendy, if you'll just.
Present.
Thank you. Okay, Carol.
Here.
Okay. Arthur?
Present.
Okay. And myself, Linda Escobedo, present. Okay. This meeting is being recorded and in accordance with regulations that are allowed by the state under the COVID pandemic. All right. I think we're ready for Scott to present the FY20 audit. Good morning, Scott. Thank you for being here.
Good morning.
We couldn't proceed without you.
Well, thank you, and good morning to all the members of the committee and others from Concord and Concord Public Schools. I see a couple here. Thanks very much for the invitation to come get together this morning. I was going to say come in. It's kind of what I usually say when I'm in front of a board. Still getting used to doing all of these virtually, but it's the way it is right now. Anyway, with me in one of the boxes is Sarah Kodak. She supervised the engagement in Concord, and together we're going to be presenting. In just a few minutes, I'll have Sarah share her screen if it's okay with the committee to walk through some of the key highlights of our audit of your financial statements, as well as a couple of management letter recommendations that we have. And perhaps before we dive into balance sheets and income statements and some of the meat and potatoes, if you will, of your financial statements, we always think it's appropriate to let you know that how our audit went. And our FY20 audit of the town of Concord went well. We issued your prior year CAFR at the end of January of 2020. After today's meeting, we've a few housekeeping items to perfect in the CAFR, but we hope to be issuing here within a week. A little bit ahead of last year's issuance of your June 30, 19 CAFR. With everything that's going on, working remotely, we would have loved to have been able to issue at the end of December, but things just didn't come together like we hoped that they would to issue within that 6-month period after year end. But certainly within maybe a week, we expect that we'll issue these your comprehensive annual financial report. So, with that said, other things to just let you know how our audit went. We found the books and records to be in good working order. We did not need to propose any significant audit entries as a result of our work, and there were no disagreements between the town and our firm and how to apply generally accepted accounting principles. If those seem almost like required communications for an audit firm to make to a committee like this, it's exactly what it is. Those are required communications, letting you know how the audit went, the fact that we did not need to propose any significant audit entries as a result of our work, and that there were no disagreements in how to apply generally accepted accounting principles in the preparation of your comprehensive annual financial report. Lastly, before we dive into a few number pages, if you will, we did issue a management letter, which we'll talk about after we go through the CAFR, but there are no material weaknesses that were uncovered as a result of our work and no significant deficiencies that are reported as a result of this. The comments that we have, as are defined in the opening letter of the management letter, just highlight those as recommendations to improve and streamline controls within the community. And very lastly, before we dive into a few things, is our audit opinion. And once again, and no surprise here, but we did issue an opinion or an unmodified opinion, meaning there are no modifications, and your financial statements are materially fairly presented in accordance with generally accepted accounting principles in the United States. We'll turn to that page in just a minute because I think it's pretty important to highlight that. And lastly, Sarah, before I ask you to share your screen, much of the CAFR that we're going to walk through today focuses on 4 specific areas. The first is your unassigned fund balance in the general fund. That we'll probably spend a fair amount of time talking about that. If you've had an opportunity to look at the CAFR, you are going to see that for the first time in I think a couple of years, you see a drop in that fund balance. We'll highlight the reasons why. It's all spelled out in your management's discussion and analysis, why that key account, and oftentimes it's the first place that most readers will turn to in looking at your financial statements, is your unassigned fund balance in the general fund. Now, and it did go down. It went down about $3.9 million. And again, we'll turn to some pages that really highlight the reasons for that. But that'll be a big focus of the conversation this morning. The other three areas, the first of the other three areas would be your outstanding bonds payable, or your debt position. We'll take a look at some of the key footnotes associated with those. Specifically, the question that is often asked by financial institutions and credit rating agencies is how rapidly is the debt being paid out. We'll show you where you find that really important information. And the other two areas are pension and OPEB. OPEB being an acronym for other post-employment benefits, and what they mean by other is other than pension. So pension is the town's unfunded pension liability to the Concord Contributory Retirement System, and OPEB deals with retiree health insurance. We'll spend some time looking at those liabilities on your statement of net position and talking about some of the key assumptions that go into them. But in the end, I think what is important, and we'll highlight the page in your MD&A, is that the retirement system is a very well funded system. Sure, there is an unfunded liability out there, but it is a well-funded system, and it's on pace to be funded in not the too distant future. On OPEB, your plan's about 36% funded. That's one of the stronger ones that we see in the Commonwealth, but one that is consistent with peer communities to Concord. And what I mean by that is they're similarly rated. So, with that, Sarah, can you please share your screen with our audience here this morning, and go to our opinion page? And as she's doing that, hopefully this will simplify things a little bit. When she calls up our opinion, you're going to see that on a printed document, it's page 11. If by chance you have a PDF copy of the document, perhaps up on a monitor or one of your monitors, the page that you would want to turn to is page 21. Again, she's going to share it. It's going to come up as being a printed document page 11. If you have a PDF, it's 10 plus 10 pages. Maybe that's just a little something that can help you navigate through the PDF that you may be trying to take some notes on as we go through this.
It says the host has disabled participant screen sharing, so I can't.
Well, we'll make do. I suspect that most of the audience that we have here today has the PDF from the email that they received, and if I could ask you to turn to open that PDF and go to page number 21. Again, it would be print page 11, but PDF page number 21. And our opinion goes on for a couple of pages here. And obviously, it's headed up that it's addressed to the select board, and it tells you about our on the first page. It tells you about our responsibility and management's responsibility. It also goes on to tell you the auditing standards that we followed in conducting our engagement. We followed two sets of standards. We followed generally accepted auditing standards promulgated by the American Institute of Certified Public Accountants, and also GAGAS, or GAGAS, generally accepted government auditing standards, put out by the Government Accountability Office. So we conducted our audit in accordance with both those sets of standards. The third standard deals with publicly traded companies, so it doesn't apply to this. So it goes on to tell you a lot about the standards that we followed in conducting our audit. But the real thing that most readers want to see is over on page 12 of the printed document, so it would be page 22 of the PDF. It's our opinions on your financial statements. And in our opinion, as I mentioned earlier, our opinion is that your financial statements are materially fairly presented in accordance with generally accepted accounting principles here in the United States. Again, a clean opinion, similar to had for many years, but certainly we think it's one of the highlights of the audit to be able to know that your financial statements are fairly presented in accordance with GAAP or generally accepted accounting principles. So, with that said, probably the next page that you're going to want to reference goes over to page 19. I have a copy up in front of me, so I'm just going to scroll down.
Sarah, you should be able to share your screen now.
Okay.
Thank you, Carrie. So I'll wait just a second to let Sarah get that up there. I think it will aid in the conversation. Great. Thank you, Sarah. Again, this is print page 19, or if you were following in a PDF in conjunction with this screen sharing, it would be page 29. As I mentioned sort of before we started looking at the document here, the first place that most readers are going to turn to is your unassigned fund balance of your general fund. And the schedule that we show here in the middle of this particular page is a comparison of your June 30, 2020 balances in your general fund to the year before, June 30, 19. So your total fund balance at June 30, 2020 was 34.8, and a decrease of about $2.3 million from June 30, 2019. Now, most readers are going to focus predominantly on the unassigned fund balance, and we'll walk through what each of these components of fund balance means and what's included in them. But most will focus on the unassigned fund balance. Again, as I mentioned in the beginning, for the first time in several years, the community actually is seeing a drop in this key account balance of about $3.9 million from 2019 to 2020. We'll probably highlight a few more pages that summarize the reasons for these drop. But Sarah, if you could just scroll down a little bit, I know I'd like to see a little bit at the bottom here. At the bottom with that paragraph that starts with the unassigned fund balance of the general fund changed by 3.9 million. The rest of that page is super important because we think it really highlights for the reader why your unassigned fund balance went down by $3.9 million. To summarize it very quickly, as you perhaps can take a look at it, is you had positive budgetary results of about $317,000. All things considered in FY20, that's pretty good. But then in addition to the budgetary results, the community used some of its free cash, which is a component of your unassigned fund balance, for several areas. In particular, you added $2 million to your middle school stabilization fund. So, by adding that to a stabilization fund for a particular purpose, it now goes up into the committed fund balance from unassigned. So, and also you used about $1.7 million to reduce the tax levy in fiscal year 21. On average, I think over the past couple of years, the community has used about $1 million. So there's about a $700,000 increase in the amount of free cash that was used for the tax levy. $50,000 for school buses, but in essence, the positive budgetary results of $313,000 softened by or reduced by $3.7 million in use of free cash for various purposes in FY21 are the reasons why your unassigned fund balance went down about $3.9 million. Not it's certainly something we're seeing across the Commonwealth for fiscal year 20. The one exception would be that what's different in Concord is that the $2 million added to a middle school stabilization fund is certainly not something that we're seeing across the Commonwealth. That's specific to the town of Concord. I will normally I would probably ask to take some questions at the end, but this is probably the one page that if there's only one takeaway, I'm going to talk about many more issues here, many more areas, but if I could perhaps pause a minute, since this is such a critical page, and see if the committee has any particular questions on this page and what's going on here.
Scott or Carrie, could you speak to the stabilization fund? Does that live in a investment portfolio that's already established in the town, or is it a new and independent, if you will, portfolio?
The $2 million, I believe it is a brand new stabilization fund. that was established right at year end with the annual town meeting for FY21. And I think typically, I'll defer to Carrie a little bit, but I think typically those stabilization accounts are segregated into a particular portfolio with her as treasurer.
That's what I assumed, but I want to show my ignorance here and pose the question. Thank you.
Are there any other questions? I mean, I'm going to stay on this page for another minute, but I thought with respect to unassigned, I'd see if there were any other questions.
Hi, it's Wendy. And so Carrie, just for my edification, what's remaining at 9.9 million is still within that range of 5% to 10% of the prior year budget, correct?
Yes, it is.
And if I may, I know the question was posed to Carrie, it's still a
Sorry.
very strong balance sheet. And one that supports, in our opinion, the credit rating that the community holds and has held for a long time. So, but just to speak on the different components of fund balance here, because there's a lot of things that go into your general fund in the audit. I think I've said this to committee members in the past, is that Mary's general ledger has many different funds in it. And for report, they are tracked separately for many reasons and appropriate reasons. But oftentimes when the audit comes together, there are multiple funds within her ledger that make up the general fund. The key components would be, of course, the operating fund, which is the general fund in her ledger, as well as separate stabilization funds that are established in Mary's general ledger. And perhaps the biggest one is the town has a pension reserve fund that it is funded on a fairly regular basis for many years. Those are the three major components that make up the general fund in the audit. If you were to go look in the actual general ledger, you would see these balances in three different locations, which again is not abnormal at all. So keeping that in mind, if we look at the fund balance components here, the restricted fund balance of about $9.5 million. That is essentially the pension reserve fund balance that the community has set aside in its ledger. You see that it actually went down by $872,000. A lot of that is the market value change as of June 30, 2020. We all know what occurred from a market standpoint in late winter, early spring. That's come back, but not as of the balance sheet date. So the drop in your restricted fund balance is essentially a result of the drop in the market value with your pension reserve fund, which is a component of your general fund. The committed fund balance of 7.5 million, as you can see, that's increased by a little over $2 million. Lion's share of that increase is the $2 million that you added to it from unassigned fund balance. You moved it up because you committed those dollars to a particular purpose through the annual town meeting vote that was taken. The other part of the increase is in all likelihood some interest earnings on those funds. The assigned fund balance of about 7.8 million, it hasn't changed much from the prior year. And most of those dollars represent reserve for encumbrances, budgetary appropriations that are carried forward and will be honored in future periods. Keep that in mind when we perhaps talk about the management letter. But also included in that assigned fund balance is the $1.7 million that was used of free cash to reduce the tax levy. When that vote is taken, that $1.7 million moves from unassigned fund balance up the ladder one level, if you will, to assigned fund balance. So the 7.8 million, which is essentially unchanged, represents mostly reserved for encumbrances and about $1.7 million of free cash that will be used for the FY21 budget cycle. Sarah, could we now go over to the statement of net position, please? Statement of net position, which is print page 25 or PDF page 35. This is the first set of, in any governmental fund financial statement, there are essentially two sets of statements in here. but what I would refer to as the long-term perspective or the government-wide financial statements, and the short-term perspective, which is your fund basis. More of today's conversation is going to focus on the short term, but it would not be a complete presentation if we didn't at least draw some key account balances on a long-term perspective to the community's attention. So this page, the statement of net position, is divided into two columns. The first column is your governmental activities. That's essentially everything except your enterprise funds, which are your water, sewer, CMLP, and the swim center. Essentially everything else is in that first column of numbers. So your general fund, your pension reserve fund, all the various capital projects, permanent trust funds, and probably special revenue funds, including your CPA fund, are in that governmental activities. And you can see about 2/3 of the way down that page, you see you have your long-term assets in there, your capital assets, and then below that, deferred outflows of resources related to pension and OPEB. If the group would like to talk about those account balances, we certainly can. And if you could just scroll down to the next page, Sarah, which is the liabilities and net position section of your statement of net position. Again, almost right in the middle of the page, you see two of those four. I mentioned sort of big four areas that we were going to focus on: the unassigned fund balance, your debt position, and your pension and OPEB. So, just starting in the center there, the bonds payable net of a current portion. Current portion is about 6.2 million, and then in the payable section that is net of the current portion for governmental activities is about $32.3 million. So we'll focus when we focus on bonds payable, we'll really be looking at the footnotes, and you'll see that the community, in accordance with its existing policy, has a very rapid payout of its bond payable. Essentially, we'll see it in more detail later on, but essentially all of your debt is paid off within 10 years, which is very aggressive. And again, it goes to contributing towards the credit rating that you currently hold and have held for a long time. A couple of rows below that, you see your net pension liability and your net OPEB liability. And I'm going to focus, for simplicity purposes, in the first column there. The enterprise funds, we can talk about those if the community would like, but I'll focus on the governmental activities. And the combined liability for your pension and OPEB is a little bit more than $51 million. About 17 of that is pension, and a little more than 35 million is your OPEB. Now combined, as I mentioned, also I mentioned earlier that the pension plan is 85 or something percent funded, and the OPEB fund is about 35% funded. So those are really admirable percentages, and again speaks to the community and the rating that it holds. They are towards the top from our perspective in the Commonwealth when it comes to the percentage of completion towards becoming fully funded. But nonetheless, these represent the unfunded portions. They're much smaller than most communities we work with. I mean, they're big numbers, obviously, but they are much smaller than what we are accustomed to. And that $51 million between those two liabilities, and this is an easy way to look at it, or I hope an easy way to look at it. If I draw your attention to the very bottom of the screen, you see your unrestricted net position in that first column of numbers. It's in parentheses of $27.2 million. Maybe an oversimplification of it, but this is the way a lot of people will view this statement, is with those two unfunded liabilities, or underfunded liabilities is a better way for me to categorize them, of $52 million. Without those two, you would have essentially a positive unrestricted net position of about $25 million. It is clearly those two issues, which are well on their way to being funded, that is the only reason that the community has the negative unrestricted net position in its governmental activities. Now, as a point of reference, and again, this is the long-term perspective balance sheet. As a point of reference, that unrestricted net position in the first column of numbers, that was about $31 million negative in the prior year. It's gone down, or it's improved, and the primary reason why it has improved is that in FY20, the community received a sizable grant that it used for the rehab work on the Cambridge Turnpike. I think it was actually a little over $5 million in grant money that you received that it wasn't spent on operations or anything like that. It was, what you did with it was you constructed and reconstructed the Cambridge Turnpike, and creating a capital asset which will depreciate over time, but that the cost of that is recognized over a 40 or 50-year period in the future. So, just to recap then, the negative unrestricted net position, it improved over the prior year, principally because of the grants that you received that you used to rehab the Cambridge Turnpike. And then the negative part of that number is really driven by the pension and the OPEB liabilities. So, as a point of reference, just focusing in back on the two liabilities, the net pension liability, that's actually, pardon me, the liability is actually down about $7 million over the prior year. But I would want to remind the community and the committee that even though this is on your June 30, 2020 balance sheet, the net pension liability is measured as of the end of the calendar year. The retirement system has a calendar year end, and the liability is measured as of December 31, 2019. So it was before there was adjustments to the market based on the COVID-19 and what the market experienced in late winter and spring of 2020. So again, it's great to see that liability has continued to come down, and it is certainly a well-funded system. The net OPEB liability, again, in that first column of numbers of just under $36 million, that increased by about $3 million over the prior year. The primary driver of that increase was a change in assumptions, where there was a drop in the discount rate that was used to measure future investment earnings. You had used you had used a discount rate of 7.25%. You dropped it down to 6.5, and so that's a sizable drop in the discount rate. We agree with it, given the fact that earnings in the fund haven't met the actuarial expectation over the past couple of years. So we agree with the town's assumption that the discount rate should have been lowered from 7.25 to 6.5. But anytime that discount rate does go down, the liability is going to go up. There were some other assumption changes that mitigated the size of the increase, but the largest single component that drove a change in that liability was the discount rate of 0.75 of a percentage point. Sarah, if you could maybe go all the way over to, let's hop over to the general fund balance sheet, please. And if you could scroll down to the fund balance section. Again, the focus here is in that first column of numbers, and those numbers at the very bottom. They probably look familiar to you, because Sarah, if you maybe can quickly go back to that page in MD&A. We spent a fair amount of time talking about this page and the restricted, committed, assigned, and the reasons for some of the changes. You go back to the balance sheet now, Sarah. This is where they reside on the actual balance sheet for the town of Concord, and to be more specific, the general fund balance sheet. Just to recap again, but the place to go to recap really is page 19 of MD&A. But the key number there is the third number up from the bottom, or unassigned fund balance of $9.9 million. It did drop by about $3.9 million over the prior year for the reasons that we've discussed, and I think are written out quite nicely by the community on page 19 of your management's discussion and analysis. You did have positive budgetary results, not nearly as positive as prior years, and we'll see why in a minute. But you also used $3.7 million for middle school stabilization and to reduce the tax rate going forward, which again is just summarizes why there is a drop in that key account balance. So if you could go over to the next page, the statement of revenues and expenditures and changes in fund balance. We're going to look at the budgetary results in just a minute. If you could go down a slightly more, Sarah. This is, again, that first column of numbers is your GAAP, or generally accepted accounting principles general fund. And the key number on this page is, once again, it's the third number up from the bottom. You see that it's in parentheses, indicating that the outflows of resources exceeded the inflows for fiscal year 2020. The reasons for that, to try to put a little snapshot together, is it's twofold. One, the budgetary results weren't what you expected, particularly on the revenue side. But more importantly, there was, in fiscal year 20, there was a significant amount of expenditures that were recognized from budget years prior to fiscal 20. I mentioned assigned fund balance included encumbrances, and there was a sizable amount in encumbrances. In fiscal year 20, you spent a fair amount of your prior year encumbrances. Those were budgeted for in prior years. You collected revenues for those in prior years. This is the drawdown and the use of those resources, as well as a large contributor to this negative 2.2 or almost $2.3 million is the drop in the fair value of the pension reserve fund, which was about $650,000. So really two things there: the expenditures of prior year encumbrances and the drop in the fair value of the pension reserve fund contribute to that third number up from the bottom. And the next page we'll look at is another income statement, but it's actually your budget versus actual comparative statement. The focus here is almost always on the last column of numbers on the right. As you can see, about a third of the way down the page, you see your total revenues. You see the number in parentheses of $757,000. Essentially, what that means is the revenues you collected did not come in at budget by about $750,000. Several components that you see there. The largest single component that contributes to the shortfall in your collections was the excise taxes, which is something we've seen throughout the Commonwealth for fiscal year 2020. So, on the expenditure side, actually one more thing I did want to point out. That $757,000 number, the total revenue in the variance column, just as a point of reference, a year ago for your results of operations for June 30, 2019, that was a positive $1.5 million. So that's a big swing, going from a positive $1.5 million to a revenue shortfall of $750,000. That's a big swing, but again, not something we're seeing quite a bit of in the Commonwealth, as I think most would sort of expect for FY20 results of operations. On the expenditure side of things, you see in that variance column, 2/3 of the way down, you see a positive $1,074,000. Essentially, those are unspent appropriations by the departments within the community. It's unspent money that was appropriated to them via town meeting. That number is fairly similar to the prior year. June 30, 19, it was about $800,000. So it actually increased a little bit over the prior year. But the combination of the revenue shortfall of $750,000 softened by the almost $1.1 million in unexpended appropriations give you the subtotal you see right below that $1,074,000 of $317,000. That number of 317 does go back to MD&A. When we tried to highlight early on in the conversation, Sarah, maybe you could just flip back to it real quickly. MD&A. Yeah, if you scroll down,
Oh, was it on this one? Yeah, that's right.
Yeah, this one. Thank you. Just to tie a couple of pages together here, the text at the bottom of this page, highlights the $3.9 million drop. The budgetary results of 317. Where that number comes from is this page we were just on, and Sarah can go back there. It comes back to the budget versus actual comparative schedule of 317. Now, below that number for fiscal year 20, I've talked a lot about the free cash that you used for FY21, but the $1.5 million that you see in the lower right-hand corner of this particular page, that was the free cash that you used for fiscal year 20. $500,000 of it for a redevelopment plan, and $1 million was used to reduce the tax levy. And again, I know I mentioned it when we were back on the other page, but for fiscal year 21, The community used about $1.7 million, approximately $700,000 more than you would use for the last couple of years. So, a couple more pages in the financial statements just to highlight a few things. If you could go to the statement of cash flows, please, Sarah, and this is page 36, or if you got a PDF of the document, it would be 46. Don't want to spend a lot of time on this because there's a tremendous amount of information here. But for most readers, this is a page where the focus is on this page is the first subtotal of numbers that you see here. It's the net cash provided by or used by operating activities. And you see that every number across there, 1.9, 1.2, $2 million for the electric, and just about 600,000 for the swim center. They're all positive, which is certainly to be expected. But the comparison that I would just like to introduce to the committee today is to compare, and I'll focus on the water fund for a minute, just to pick one column. You have $1.9 million that was cash that was generated by your operating activities. Now, if you look down into the capital and related financing section of this, look for your principal payments on the bonds in the interest expense. Principal payment on the bonds was $485,000, and the interest expense was $136,000. Financial institutions and credit rating agencies will compare the net cash provided by operations of $1.9 million and compare that with what was paid off in principal and interest, which I'm going to very much round here, but the 485 and the 135 in interest, let's just call that 600,000. The 1.9 million cash generated by operations more than covers this approximate $600,000 in principal and interest payments. Shows strong operating results in the ability the community has to use some of its operating cash to reinvest in its property, plant, and equipment, or its capital assets for the water plant and sewer facilities and things like that. That's a very, very quick walkthrough of a cash flow statement, and how financial institutions and credit rating agencies would view that. You're going to look at this page more than they are your balance sheet or even your statement of revenues and expenditures. A couple more areas to point out in your financial statements is the future debt service tables. And page 68, so if you had the PDF, it would obviously be 78. Mentioned before before we get into the actual document that one of the things that credit rating agencies look at, and Concord has a wonderful policy with respect to this. They don't always look at how much debt you have, but they look at how rapidly you pay off the debts that you have. And consistent with your policy, you're essentially paying off all of your this is a, pardon me, before I say this, I want to point out that the table that we're looking at the bottom of page 68 deals with your governmental activities. So this does not include your water, sewer, or swim facility. So it's everything except those enterprise funds. And as you can see here, essentially, almost 33 in the public offering bonds, all of those bonds, the 33 million is paid off within a 10-year period. We're on the third column of numbers, if you will. You see your direct borrowings, and there's just a requirement to disclose them separately, but it's all principal and interest that you see here. There's just a gap requirement to show them separately. With respect to the direct borrowings, not all, but I would say essentially all. In this case, certainly about 2/3 of your direct borrowings are paid off within 10 years. So if you look at it combined, you've got governmental debt of a little over $34 million, and all but 332,000 of it is paid off within a 10-year period. A very rapid payout, consistent with your policy. We see the same type of scenario on the next page. If you could just scroll down, Sarah. This is the same type of schedule. The community, I think it's great to do this, is if they show the amortization of your water debt, your sewer debt, your electric, and Sarah, there's no swim debts. Sorry, I forgot about that. You see amortizations of all three enterprise funds that have bonds payable here. And in each of the cases, both with respect to your public offerings and your direct borrowings. Each of these three enterprise funds is paying off 100% of its principal outstanding bonds payable within a 10-year period. Very rapid payout, consistent with your policy and consistent with the credit rating that you hold. In the very
Scott,
last,
can I ask one question? Can you go back up one page? There was something that didn't look right to me. So right there.
Mhm.
So the total interest of 665, where's that coming from? I would have expected it to be 332,740 in the thereafter row.
Wendy, could you repeat that question?
That's okay. So I was just noticing that the totals under in these rows after 2030, there's a thereafter.
Oh, yeah.
There's short-term, long-term, and the total of 665 doesn't tie out to the 332 plus some other principal, or the total interest, sorry. I just wasn't sure where that 665 came from.
That is a great question. And I'm going to, it certainly looks like there's a formula error in that total interest thereafter, because I think it's picking up the principal twice.
Yeah, it looks might be.
Great catch. Thank you. Thank you. As I go one row above it, the 10,250 looks like it's properly picking up the interest, but thank you for that.
Sure.
We already talked about the enterprise fund debt amortization. So Sarah, let's go to the last page we have flagged, which is another page in the financial statements that increasingly is getting more and more attention. Sarah, just to put the proper context in here, can you just flip back to the page in the MD&A that we focused on a lot? I think it was page 19. Yeah. Again, these are the components of fund balance: the restricted of 5.6, the committed, the assigned, and unassigned. Now we're going to go back to that footnote, and it's what this footnote represents is detail to the amounts that were in both MD&A and also on your general fund balance sheet. The restricted amount of 9.5, that's all restricted because of your pension reserve fund. The committed amounts, which were about $7.5 million, you can see that there's the middle school stabilization that we spoke about. There's $2 million that was included in there. You have an insurance reserve fund of about $1.8 million, and the affordable housing at the Junction Village of $1 million, which I believe was added in there from fiscal year 19, remains committed and unspent. Those are the largest components of money that has been committed by the community for a particular purpose that adds up to a grand total of 7.5. Moving down the note and goes on to the top of page 36. Not 36. The next page, I'll just leave it at that. Forgive me. You have your assigned fund balances and your money that's been reserved for next year. The assigned fund balance starts with some money that's set aside for town meeting and reports and salary reserves. You see all the various purposes there. And then right before the total assigned fund balance, you have reserved for next year's expenditures, which is $1.7 million. Because that's not reserved for a particular purpose, like a middle school stabilization account is, that's what you've actually done with that is set it aside to reduce next year's tax rate is. That's why this gets a little bit technical here. That's why the $1.7 million is considered assigned, because there's not a particular purpose associated with it. The $2 million that you added to middle school stabilization has a particular purpose associated with it. So that's a little bit of a distinction between committed fund balance and assigned fund balance. And then you come down to your unassigned fund balance. We've talked a lot about the 9.9 and how it's gone down from the prior year, but there's really two components to that. I mentioned that there's really three big things in your general fund. There's your traditional general fund, your stabilization funds, and your pension reserve. Well, your stabilization fund that doesn't have any particular purpose associated with it by definition, and that's defined by generally accepted accounting principles. So your general stabilization fund should be reported as a component of unassigned fund balance. We've just highlighted it here so that the reader knows that there's 9.9 million in your general fund and $4,500 in your general stabilization fund. So you do see it's not a significant extension, of course, but it does tell the reader that there is a general stabilization component of your unassigned fund balance in the general fund. Well, I'd like to say that was a quick walkthrough of your financial statements, but it was fairly tried to cover a lot of ground in there. There's Sarah, maybe you could scroll down to a couple more RSI pages. I wish I had asked you to flag these, but the pages she's going to turn to, I mentioned the acronym RSI. It stands for Required Supplementary Information. There's some great information here. I'm not going to walk through this in a lot of detail, but this particular page talks about the town of Concord's net pension liability and its proportional share of the Concord contributory retirement system. You'll notice that the town portion is segregated from the municipal light plant portion. That's because the town has a June 30 year end, municipal light has a 12/31, and then below that, for your information more than anything is you see a heading there for the Massachusetts Teachers Retirement System. There is a liability associated with this. It is not the town of Concord's liability. It's 100% assumed by the Commonwealth of Massachusetts. But as June 30, 2020, fiscal year June 30, 2020, there's about a $78 million pension liability that the Commonwealth has on your behalf. And your proportional share of that is zero. So 100% of that liability resides at the Commonwealth level. And on the next page down, Sarah, and again, these are RSI pages, tells you a lot of information here. The top part of this next one is you're required to make a $5.1 million contribution to the retirement system, and you make that $5.1 million contribution. At the bottom part there, the Commonwealth was required to contribute $4.5 million, and they contributed $4.5 million. Now I think we come to the next couple deal with OPEB. Some a little summarization of the changes in both your OPEB liability and the plan net position. I won't go into a lot on this page. I can certainly answer any questions. The one number I would point out in the 2020 column is the third number down from the top. You see it's a positive number, which means it increases your liability. It's called your changes in assumptions. I mentioned earlier that you dropped your discount rate from 7.25% to 6.5%. It's a sizable drop in the discount rate. When that occurs, you do see a sizable increase in the liability. That's a quick, hopefully a quick education on how to read this particular RSI page. What's next, Sarah? Okay. This is also an important page. What I think is probably the most important is the number, not the annual money weighted rate of return at the bottom, but just above that, you see your schedule of contributions. You see the actuarially determined contribution, the contributions in relationship to those actuarially determined, and you see the contribution, excess, and deficiency. As I look across that bottom row, the contribution, deficiency, and excess, those numbers are pretty small. They fluctuate a little bit, and there's some reasons for those. But in communities that aren't 30-something% funded in their OPEB trust, we often see a deficiency there of many millions of dollars. By and large, the community is contributing the ADC, or your actuarially determined contribution. There's some timing differences in here, predominantly in 2020, I believe, because the community used a roll forward procedure. So that will true itself up in another year. So. And after that, Sarah, I think that's the last RSI page. After that, there's a tremendous amount of detail that is associated with some of the account balances in there. Sarah, maybe we could hop over to before we hop over to the other document, which is our management letter, why don't I pause for a minute and see if the committee has questions on the balance of what we've walked through with their CAFR.
Hi, this is Art. I have a question. on investment income. This is on page 18.
Yes.
And it's 3 lines above the heading expenses. Do you see where I am? Yeah, that's it. So I'm just wondering, that's a pretty significant change in the number.
Yep.
From 1,600,000 to 152,000. You touched on drop in investment income generally, but is there anything that's specific to that particular item?
I think the one thing that drives that substantial change, that's a great observation, goes back to the pension reserve fund that the community has. The market value adjustment that the community needed to make at June 30, 2020 was to bring that value down by about $650,000. I should have looked this up, but I didn't. But I would tend to think that as of June 30, 2019, there was a sizable increase in the fair value balance of the pension reserve fund. So it is not, I think the swing of $600,000 is the largest driving force that you see here, going from 2019 government-wide investment earnings of 1.6 down to 152. It's predominantly that.
Okay, thank you.
Another component of that would certainly be the town has what you would refer to as permanent funds set aside for cemetery perpetual care and things like that. And the market value swing on those funds wasn't nearly what it was on the pension reserve fund, but I do know that that would be another contributing component to the drop in investment earnings from 19 to 20.
Any other questions?
It's Wendy. I have a question, and maybe this is for Carrie. So, Scott, you mentioned that the discount rate on the OPEB was dropped from, was it 7.25% to 6.75%? Did we make any adjustment to the pension liability discount rate? I didn't hear that we did. I just wanted to just ask what that rate was.
So first, let me say the change in discount rate assumption on OPEB was made by the actuary, and not, I think it was probably the right thing to do, but it certainly, unlike with the retirement system where we have a discussion about what we want to use and we inform him, he informs what would be used. And the discount rate that we're using for the retirement system now, we just dropped to 6.9.
Can you say that again, Carrie? You just broke up a little.
The discount rate that is being used for the pension liability is 6.9%.
Okay.
And it had been 7%.
Okay. Thank you.
Carrie, can I just confirm that's what you're using for 12/31/2020?
Yes. Well, I believe Mary, maybe you can correct me if I'm wrong. I think we may have been using that for the prior year.
Yeah, I thought what was the 6.75? Is that the new?
That's okay.
That's okay. I thought for pension, I thought we were looking at the 6.9 then. Okay.
I just have an observation on page 120, I believe it's 120, where you talk about CPC and other special revenue funds. There's reference to the original budget and the final budget. And I'm wondering if there's some kind of asterisk or explanation that should be made for those two columns. Explaining why the final budget is different than the original budget. And it clearly was COVID related, and a later town meeting, correct?
That's a great observation. And I believe, forgive me, I've got to look down. If you go to page 30 of the document, of the PDF. You see it discloses for the reader that there was a decrease in the appropriations by about $900,000 in that would have otherwise come in. This deals with a lot of the indirect costs between the enterprise funds and the general fund. There's actually a decrease in the appropriation and the resulting transfers in from other available funds. So the disclosure is pretty much in the front, and I know you were in the back. It's certainly something that could be added to the back to help connect the dots, though.
That was just my observation and suggestion. Yeah.
Thank you.
The other question I have is that you duly note that there are new standards for the audit going forward, the GASB 84 and 87.
Yes.
And I assume that that has already been, some review of that and what's required has already taken place with the finance department so that they're set up for the next audit.
Some of it has. I know in speaking to Sarah yesterday, I know I asked her to let Mary know that I'd give her a call once this thing was published to just review Statement 84 one more time. Statement 84 deals with fiduciary activities, and there's a likelihood that certain accounts within Mary's general ledger, new accounts will need to be added to create, for lack of a better term, income statement accounts, because certain activities which have historically simply had just assets and offsetting liabilities will now need revenue and expenditure accounts to be able to produce an operating statement. Been a lot discussed about this standard in the Commonwealth. It's not going to be I think it's going to be a big undertaking for the community to implement this. It's probably at most a handful of few additional accounts so that full revenue and expenditure year-to-date activity can be used to produce an operating statement for these new types of funds. 87 is actually, perhaps a little bit of a sleeper statement, and this deals with leases, and it was scheduled to be effective for FY 20. Sorry, I have to look down at my notes. Anyway, it actually, the standard was delayed a year last spring because of COVID. And that's, in all likelihood, it's going to really help governments, because governments in general do a lot of leasing activity. And they have a lot of operating leases, what have historically been known as operating leases. And under this new lease standard, all leases, the distinction between a capital lease and an operating lease really goes away. So governments are going to have to really take a robust look at all of the leases they have, both as a lessor and a lessee. And you've got about a year to get this information together. And yeah, I'm not saying this is going to take a month to do, but it's probably going to take a couple of days or maybe even a week to do a complete accounting of this and get the information centralized so that an evaluation can be made of any additional lease liability that might be out there. And just as importantly, there may be a lease receivable out there that would need to be recognized in your government-wide financial statements. Those are the two big changes that are coming down the pike.
Thank you. Any other questions from the committee? All right. Are there any questions from the public on the audit? Carlin? Carlin? You're on mute.
There we go. Now I got it. Carlin Reed, 83 Wits End. I'm the chair of the PEG Access Committee. You have not touched on this, but I just want to note it briefly to make sure I understand how the PEG Access funds are recorded as part of this audit. On page 110 of the actual document, it's part of it's the combining statement of revenues, expenditures, and changes in fund balances, non-major governmental funds. Okay, yes, that's it. My understanding is this is where it shows the PEG Access revenues and the expenditures, the and then the fund balances at the beginning of the year and at the end of the year. This is that small column there. Am I correct that this is the information as of June 30, 2020? That's the question I have.
As of June 30, 2020, and this is probably me being a little bit of a geek, the bottom line number there of $1.4 million, that's as of June 30th. The rest of the numbers on this particular page are for the year ended. That's the only distinction. It's not as of, it's for the year ended. It's the revenues for the 12-month period ended June 30 and the expenditures for the 12-month period. So minor distinction, but I just wanted to try to clarify that.
Okay, thank you very much.
Carrie, it's Wendy. I just need to acknowledge I need to drop. Thanks.
Thanks, Wendy.
Yep.
Okay. Okay. Any other questions from anyone?
No.
All right. Well, thank you very much for this presentation. And you, if you'll again just revisit when you expect this to be in its final form.
Certainly, do expect that it's going to be finalized, shortly. By that, I would say within, I'd say about a week. If I could, I did have another document I wanted to quickly touch upon. I touched on some of them when the chair, I think it was the chair, who asked me about some of the new GASBs coming down the pike. But Sarah, if you could maybe just pull up the management letter for just a quick minute, if it's okay.
Yeah.
It's a byproduct of the audit. These are some of our observations that we think where improvements can be made. Go right to the page 3, but as you're scrolling down, we do encourage the community to read page 1 and 2 very quickly. It tells you a little bit about what we did and just as importantly, what we didn't do. We didn't look at every single transaction that went through the books and records. It was based on statistically sound samples. And as I pointed out at the top, these are some suggestions there. We did not uncover any material weaknesses or significant deficiencies in the result of our work. Our first recommendation is just to improve year-end cutoff. The town does a great job within its general fund of cutting off invoices that are associated with the fiscal year that they apply to. Not uncommon where a community has capital projects that may extend multiple years, sometimes 3, sometimes even 4 years, that the cutoff of when an invoice applies to a particular fiscal year, it isn't always, it's important not only for the general fund, it's also important for capital projects as well. What we found was that there were a couple of invoices for services that were for fiscal year 20 that were, instead of being charged off and recognized in 20, they were charged off and recognized in 21. We talked with the community about it, bringing them back and recognizing them in FY 20. Again, this didn't impact the general fund budget or anything like that. It all dealt with capital activity. Issue number 2 here is what I was asked about earlier, statement 84 and 87. We can talk about more on that if desired. And now just quick follow up on a couple of prior year issues. The first one is to align the encumbrance policy and its practice. Mentioned reserve for encumbrances or a component of your assigned fund balance. Essentially, over time, the encumbrances have grown to be a sizable amount. And from a GAAP standpoint, and also as defined in your policies and procedures, is that an encumbrance shall be for a specific purpose at some later date. Some of the encumbrances are generic and carried forward for generic purposes within a particular department. The town hasn't yet had a chance to respond to this, or that I've seen. I've certainly seen the response from the prior year. We agree that it's going to take multiple fiscal years to sort of phase in complete alignment of the encumbrance policy and the practice. And lastly, or issue number 4, deals with water and sewer receivable reconciliations. I think the community would remember that all the way back in the spring of 2019, you implemented a new utility billing system. And the long and short of it is there's been some challenges with respect to reconciliations in this new system. And at the end of the first paragraph, you see that as of June 30th, there was some variances of about 83 grand and 180,000 between water and sewer respectively. And we say a variance, we mean between the detailed list of receivables and the control account that exists in the town's general ledger. Work continues in this area, but it is still something that the community does need to get resolved. Thank you for the opportunity to just quickly touch base on those few issues. It was actually one more, Sarah, if you could scroll down. Some withholding accounts in the general ledger, general fund. Not a huge issue here. It's not certainly not at all, but something that can and should be taken care of sometime in the next 6 months. I would hope. Certain payroll accounts have credit balances that appear to be growing rather than zeroing out. Withholding account, normally the money goes in and it's paid out in a fairly short distance after the money is credited to the account. We see one of the accounts growing, and one of the withholding accounts actually has a debit balance that's unchanged from the prior year. And these accounts would normally have credit balances or zero. So there's just something that needs to be taken care of in a couple of your withholding accounts. Certainly not even remotely close to the issue number 4, or the size of the variances and the receivable reconciliations that we talked about in comment 4. The amounts here in number 5 are quite small, but it still should be taken care of.
It has to do with some of our insurance accounts and where we're self-billed. It's the way that the town is handling that, and I think there was a lot of work being done, I think, over the last 8 months to try to get to what they call a list bill. But I think, from my understanding, it was determined that this particular software vendor, not sure, can be able to handle that. So it's a discussion we need to have in terms of how we want to, moving forward, how we want to handle that.
Thank you for letting me have the opportunity to just quickly touch base on those issues.
Carrie, this is Art. Could you, when you have the responses drafted, could you circulate those, please?
Yes, we will do that. We had hoped to have them for today's meeting,
Sure.
but it came together pretty quickly. So we will have that done within the next week or so.
Thank you.
Okay. Well, thank you very much, Scott. And
Sarah.
important for us to review, as you can well imagine, and your explanations are very helpful to us and to the public as well.
Thank you. Then we'll sign off and the committee will continue, or is there a desire to have us remain?
Well, I'll echo the thanks. It was a good presentation. Thank you very much.
And
Thank you.
And I think you have plenty to attend to, I'm sure. So you're welcome to stay, but feel free to leave if you want to.
Thank you.
Scott.
I'll sign off then.
All right. Thank you.
Before you go, do you have any update for the committee on the status of the district's audit or anything else?
I know Ian's on the line here. Unless something's changed in the last couple of days that I haven't been briefed on, we need a few documents from the school district, and then when we get a few things, we can turn this thing around quite quickly. But we need some documents from the school district.
Yeah, we're working on sending those over, and we're also been in touch with the actuaries to see if we can get our report finished soon. Usually when the town's done, they can quickly wrap it up. So that's what I'm hoping.
Good. All set there?
Thank you.
Okay, thank you. I'm now going to return to the first item, which was approval of our minutes from November 10th, 2020.
I'll move to approve.
Okay, wait a second. Carol?
Second.
All those in favor, we need a roll call vote. So Art?
Yes, approve.
Carol?
Approve.
Arthur?
Yes, approve.
Myself, approve. and Wendy has had to leave. All right, so I note that there are 4 of us who approved. All right. In terms of our next meeting, Carrie, you already indicated you'll be circulating your responses to the management letter.
Linda, before we move on, I just have a quick question. One of the things we had talked about at our meeting back in November was the need for the loan agreement between the light board, the light plant and the broadband. And I was wondering, are we going to see a draft of that? I don't know if it was ever circulated.
So I remember some explanation that was sent out generally. I'm sorry, Wendy has already had to leave. Carrie, do you recall?
Yeah, I'm trying to remember because I believe it came up at one of the most recent light board meetings. I'd have to follow up. I can't remember off the top of my head.
So
I think there was a draft that had not yet been voted upon by the light board.
Yeah.
okay, so they've developed a draft. We just haven't seen it yet. Is that?
They definitely have developed a draft. I'm not sure if it has been approved or not, but I can follow up.
Okay. All right. It was an outstanding item I had here, so.
Yeah, good point.
Yeah, thank you. I do remember some follow-up information shortly after our last meeting referencing that draft, but yeah, we'll do some further follow-up. Great, thank you for bringing that up. So Carrie, beyond that, in terms of the next meeting, do we have some pressing business that we need to attend to in the short term?
So your only short-term business would be a follow-up on the agreement, as just mentioned, receiving responses to the management letter, and then reviewing the committee's letter that goes to the select board.
Correct.
Could schedule a follow-up meeting maybe in a couple of weeks.
Okay.
Other than that, we would just be waiting to receive the draft from the district.
Okay. So in a couple of weeks would bring us to the February 2nd. If we stuck to Tuesday morning at 8:30, does that work for everyone?
Sounds good for me.
Yeah, that's good.
Barry, does that seem a reasonable amount of time, the 2 weeks?
Yes.
Okay, good. Right. Let's February 2nd.
Groundhog Day.
Okay, at 8:30 in the morning for a follow-up meeting on all the topics we just listed. Okay, good. Any other business that committee needs to bring before us? Okay, we already allowed for public comments, but if there's any last public comment, I'm willing to entertain that. Okay, if not, I will entertain a motion to adjourn.
So moved.
Okay. Okay, and sorry, we have to call a roll here. Carol?
Yes, approved.
Okay, Court?
Yes.
Arthur?
Yes.
Myself, Linda, yes. And Chair so declares. Thank you, everyone. Good meeting. See you in 2 weeks. Thanks,
Stay
everyone.
healthy, everybody.
Thank you
Thanks
very
for
much.
all the work behind this. Yeah.
Yes.